Hi everyone, welcome back to our video series titled Investing 101 with Dr. Peng. Join with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi Dr. Peng, great to have you back again.
Hi, it's great to be back.
Right. So in this five-part series, Dr. Peng and I will be talking about important investing concepts such as inflation, equities, bonds, gold, and expected returns. In the first episode, we talked about inflation and its impact on society. In the second episode, we talked about investing in equities. In the third episode, we talked about bonds. And in our previous episode, we talked about gold. Today's episode will be a bit more technical, but I believe equally important. And that is return expectations of asset classes.
Sure.
Right. So Dr. Peng, what do we mean by expected returns?
So it basically means if I'm investing in these various different asset classes, or if I'm investing in a portfolio, what can I expect in terms of my returns over a period of time? And so that's what we call the expected return. So it's about forward-looking how much returns realistically I can get.
Yeah. So what is, you mentioned realistic returns, right?
Yeah.
So what is a realistic expected returns of different asset classes such as like stocks, bonds, cash?
Right. So that's a very good question. And it's, first of all, I want to say that it's very difficult to precisely calculate what the future return is going to be because nobody knows what the future looks like. So when we talk about expected return, forward-looking, it's typically in the context of our overall return distribution. So when we talk about expected return, it's really the mean of that distribution. But it's by no means it's that precise, that's one number. It's actually a little bit spread it out like everything else. So there could be a high estimate, there could be a low estimate, there is the average estimate. And typically when people talk about expected returns, it means the average of that distribution.
Right. So let me try to wrap my head around that. So it means that, let's say we are talking about equities, right?
That's right.
So some years, like in 2023, we see that returns can be greater than 20%.
That's right. That's right.
Year, right. But we
so
also
that's on the higher end of that distribution, right?
Yeah. But that's normal. Essentially, that's how stock markets behave,
Exactly.
Right? In
So
2022 is down 20%.
So when we talk about expected returns, I really want to make sure people understand it's not a point estimate. That point is typically the average of future return distribution. But there's a distribution around it. Like you said, every given year, it can be falling higher or lower than the average number. So the average number is still important, but it's also important to realize that there's a distribution around it rather than just one single number.
Will this distribution tighten over time, as you get longer and longer in duration?
That's exactly right. So as your investment horizon became longer and longer, because the characteristics of these returns, they are somewhat uncorrelated over a period of time, especially at stock market returns. So the longer you invest, the distribution became narrower and narrower in terms of the spread. And so the tightness around the average became smaller and smaller.
Right. So we call it expected returns, right? So we call it that way because we recognize that there are unexpected returns and or events, right? For better or worse. So let's say we use the example of the COVID-19 pandemic, right? So when the year started, when year 2020 started, not many people were talking about this, and of course I'm pretty sure that most, if not all, would not have expected the extent that the pandemic would bring.
Correct.
So so does expected returns, I assume it wouldn't account for these kind of black swan events?
So you're right to some degree that nobody knows the future. Just like you mentioned, nobody knows COVID, right? So there's always these unexpected events that we have never observed historically. We have never expected that it will happen precisely that way. So in that sense, it's not precisely incorporated into expected return. But on the other hand, there's a lot of historical events that when we do different ways to form our expected return forecast or estimates, I should say. When we form these different expected return estimates, there are historical unexpected events that are already baked in. So in some sense, I want to think that even though let's say we did not precisely anticipate COVID and so forth, but COVID happened itself is not entirely excluded from our expected return process and methodology.
Right.
So in some sense that there are historical events and so forth, when we use the historical numbers and so forth to form our estimate for future, it to some degree considered some of these possibilities, even though not precisely.
Right. So essentially, when we look at historical data and we have expected returns moving forward, we sort of expect the unexpected already. In a sense.
To
a certain extent.
To some degree, yes.
Right. Okay. So at Providend, we use a planning return, right? And how we derive this expected returns after fees is based on the Ibbotson-Chen model, which you are a co-author of. Right, so it's a scientific way of determining what our investors can expect in the long run. When they invest in different portfolios that we have.
That's correct.
So can you just very briefly explain how this would how you derive the expected returns using this model?
Right. So before I jump into talk a little bit about the specific model that I collaborated with Roger Ibbotson, who was a Yale professor. Retired now, and my mentor. But let me talk a little bit about the importance of expected return. Expected return is super important for individual investors because two aspects. One is that it's a number one important input in determining the portfolio allocation. So for example, if we expect equity return to be 9%, versus 8%, then we need to allocate more to equities, right? Everything else hold equal. So it's a very important input into the portfolio construction, allocation process. That's number one. Number two, the expected return among different asset classes is also super important when we try to determine the financial planning side of each investor. How much money you're going to accumulate over time is a direct function of the expected return and the distribution around it. So these are hugely important. And it's not just important for Providend, it's important for millions or billions of investors globally. So not surprisingly, there has been a lot of research from academic, from industry, looking at how to improve the estimate of expected returns over time, as well as the distribution around it. And so the paper or the model you mentioned called Ibbotson-Chen is something that I worked on a number of years back with Roger Ibbotson, which we basically improved, and I think it was widely regarded that we improved the estimate of the stock market return because that model is adopted as a part of the curriculum for the CFA examination and for many, many other textbooks. So at Providend, a couple years back, when we look at how we estimate our expected return, we also adopted this particular approach in the equity forecast.
Yeah, I think it's very important that we use something that is robust, right? I mean, if let's say we just use a simple back test, let's say 10 years.
Right.
You can see certain time periods where equity returns on an annual basis is like 12, 14%, right?
Or lower.
Or lower, right? Or
right.
It could be, the last decade, right? 0%, right? So, but let's say we use 12 or 14% per annum towards the higher side. And then we plan our retirement based on this number, right? And let's say our retirement is 15, 20 years away, you just compound it using 12%. It's going to be, I mean, we can never be sure, but chances are you're going to fall short.
The probability of a over a long period of time, the average return is 14 to 15%,
Yeah.
is very, very low,
Yeah.
right? And so therefore, if you based on your portfolio construction and your financial planning based on a expectation of the equity market return 14, 50% over time, chances are you're going to be disappointed.
Yeah.
Not only you're going to be disappointed, you probably will not have enough money as you expected when you come to try to meet your goals and life goals and so forth. So it's important to have a realistic and robust, estimated expected return.
Yeah, that's why we take it really seriously, because it's like you mentioned, if the returns are not realistic, and I mean on the other side, right? If let's say it's too low, right? If let's say we use too low,
too low is not good either.
Yeah.
So
because you have to invest more,
that's
and
right.
you cannot enjoy life
right.
as much today.
That's right. So it's important to get it roughly right in terms of the average as well as the spread, the distribution. So we know, okay, on average, how much can I count on this portfolio? And then also, okay, for most investors, you probably care more about in a not so good scenario. Okay, what can I expect? Is that so? The average, let's say, the market maybe 8 to 9%. Okay, on the lower end, over let's say 10 years, 15 years, 20 years, how much can I expect? And can I tolerate that? Or if that scenario happened, what happened to my financial plans and so forth?
Right. So essentially, we want to make the best guess possible of the future, essentially.
Yes.
But what if, at the end of the day, it's still something not guaranteed, right?
No guarantee, because nobody
guarantees.
knows the future.
Yeah. So what if, the portfolio is not, it seems like the portfolio is not giving the expected returns.
Right.
Maybe you can use it, you can answer this in the context of in the short term and also the long term.
So, we mentioned nobody knows what the future expected return is going to be. And early on, I also talked about expected return is not just a number, it's actually a spread, a distribution around it. And so what hopefully we do is we help investors understand what are some of these probability on average, what's the more optimistic scenario where returns are better, and what's the more pessimist scenario where it didn't do so well, and what's the consequences, and therefore help investor to prepare. We will never know. I will emphasize many times, we will never know what the future returns or the future returns look like, because precisely we don't know. Nobody knows. But what we can do is help investors have a reasonable expected return on average and a reasonable understanding of what the likely scenarios are, and then better prepared if and when those scenario occurs.
Right, so we've been talking about expected returns of stocks so far. So what about bonds, right? So I would suppose it's easier to derive expected returns of bonds?
It's relatively easier because bonds, the way you get returns on a bond investment is by collecting interest, which often is a fixed prescribed in the bond issuing document. It's a fixed percentage and so forth, and then you get your principal back. So in some ways, when you look at bonds, there's less moving parts or less noise when they are trying to form a robust estimate of expected returns. And so for bonds expected returns, we talked in the episode in the bonds and in the stocks episode to some degree. The expected returns is lower because bonds inherently is less risky, and so it's lower. If we look at today, where long-term interest rate is between 4 to 5%, so for a bond portfolio, will probably return gross of fees probably around 4.5-5%.
Right.
That's the estimate.
Right, but for bonds, it's a bit different in the sense that it's interest rate. The price is directly linked to how interest rates are.
That's right.
So should we account for a sudden cut in rates, or a future expected, rather on the longer end of the curve?
So when you look at expected return in the bond market, probably one of the best, most reliable forecast is what's the yield today in the market. So the yield today in the market reflects in aggregate, the market expectation of how much the bond should return over the entire life of the bond, or the remainder life of the bond. So that gives you the sort of the market view. And the market is participated by hundreds and thousands or tens of thousands different investors, some large, some small, but all have a different view. And so with that reflected, that tend to have the collective wisdom of all the investors, and that give us a relatively robust estimate of what the bond returns look like going forward.
Right. Yeah. So of course, we usually these fluctuations of interest rate is based on new news.
Correct.
That is not priced in. But the thing is, we cannot. Same for stocks, right? We don't know what new information.
We don't know what that is going to be, and we can only rely on today. What's the best estimate? What's the all consider everything? What's our best estimate? Yeah.
Right. Okay. Thanks, Dr. Peng. So, should we, when we are deriving expected returns, right? Do we base it on historical data, or should we use things like potential future earnings? Should we account for those?
So, first of all, when we look at expected return, it should definitely be looking forward, right? But that being said, a lot of these expected return is reflection of the long-term supply and demand equilibrium over time, right? And so if so when you consider in that context, the historical numbers also reflected over a long period of time for example, what investor demanded the return would be on equity and what's the market supplied. And those two meet together form the historical series. So there's a lot of information contained in the historical return numbers we can utilize. But there's equally a lot of number contained in today's market. So when the best practice today typically is a combination of what the historical numbers look like, and there are components of that. We would use that to do the forecast, and then also what the current market conditions are. So by combination of those, tend to give us the best estimate.
Right. So at Providend, we use dimensional funds.
That's right.
And for dimensional funds, it's tilted towards higher expected returns, right?
Right.
Things of high expected returns like smaller size companies,
value companies,
stocks, value stocks being stocks that are priced cheaper relative to the market.
Correct.
So, can you elaborate more on on why value stocks would have a higher expected return as compared to growth stocks?
So we talked about value and growth. So you mentioned value stock is just the stocks on a relative basis are priced lower. So we know, when we buy something at a cheaper price compared to something similar but at a higher price, then chances are the cheaper price item will produce higher returns over time. So that's just sort of a basic logic, right? Cheaper price leads to higher returns. And that's basic logic. And if you take a look at that logic, does that manifest itself in the market? And it does show up in the historical data. So when we forecast or when we construct our portfolios, we took that into consideration. And so at Dimensional, they would take that into consideration and say, okay, these value stocks, we understand basic logic because they're cheaper price, tend to produce higher returns. And we also look at historically, okay, investor recognize that, and this is how much higher return it had produced, roughly 2 to 3% per year. Okay, knowing this information, when we construct portfolios, how do we take that into consideration? And so that's what at Providend we do for our clients. Right. And so that's one way to smartly use the information that we gain by looking at these expected return analysis and help investor build better portfolios.
Right, and the numbers don't lie. I mean, when we look at how values perform against growth using long-term data, we see that, of course, value and smaller size companies
That's right.
do outperform. However, it's not as straightforward as that, right, Dr. Peng? So, for example, in 2022, value did better, but in 2023, the market was driven by the Magnificent Seven, which was mostly growth stocks, right? So, how should we view that? I mean,
so when we look at these expected returns or higher expected returns on value stocks and smaller company stocks, these returns, like I mentioned, at the very beginning, these expected returns or higher expected returns is a distribution. So, and particularly in very short period of time or shorter periods, these expected returns, the distribution around the average, so the average is higher, but the distribution around the average can be pretty volatile in a short period of time. So what happened is that in a short period of time, you could have years with very good expected returns on these small cap and value stocks, but there are also many years that the returns are not so good, like you just mentioned last year on value stocks. They underperformed the overall market because some of these larger growthy companies, which is represented by these technology companies, did very, very well. And that's normal.
Yeah.
Because if value stocks always outperform, then there wouldn't be these extra returns, because then everybody would buy into value, then diminish the higher returns already. It's because that periodically these value stocks and small caps underperform. That's precisely this reason that can make this higher returns last. Because if there's no risk, it's always higher, then nobody would buy large company stock. Nobody would buy growth stocks, right?
Yeah.
Then it doesn't work. Yeah.
Right, that's a good point. I mean, a lot of people forget that from 2000 to 2009, the US essentially returned nothing, right?
The lost decades.
Yeah, the lost decade. The US market, the S&P 500, in fact, had negative returns by the end of 2009 over the past 10 years. So that doesn't mean that, we should all be in cash, because, cash performed better than the market even after 10 years. So I think maybe we can use this same lens when viewing investing in things that are high expected returns, is that yes, the expected return is higher in the long run. Yes, you can expect outperformance, or rather on a relative basis, but it's really to recognize that periods of underperformance would occur.
Does happen.
Yeah.
That's part of the distribution. I mean, like what you mentioned, the period, ending in 2009 is the lost decades. And but if you look at historically, it's all about probability. Investment is all about probability. How do I increase the chance of higher returns, reduce the chance of lower returns? Now, investing in stocks, we did have periods that there's this lost decade, the returns are much lower, but we should not make our forward-looking decisions based on these extreme, downside events. They're part of the distribution. We need to account for it, but we also need to recognize it's a very small probability that happens. And so we shouldn't overly emphasize those downside events. We need to recognize it, we need to manage it, we need to diversify and find ways to deal with it. But we shouldn't make our investment decisions solely based on a relatively small probability scenario.
Right. Okay, so I'll just ask one last question is, as an investor, should I just go for the highest expected returns portfolio? If let's say I have a long enough time horizon, should I go for just, go for the highest expected returns?
Yeah, we talked a little bit about this, in the previous episodes as well. That expected returns, it is a number, and oftentimes people are attracted to that number and thinking that higher expected return is better than lower expected return. That's only half the story. The other half is that when a portfolio generates higher expected returns, they also associate with higher risk or higher up and downs, right? So to realize that higher average return over time, you really need to make sure you have the ability to endure the up and downs over a long period of time. If you cannot, then those higher expected returns that put it up there is not realistic to you, because to be able to receive those returns, you have to stick to the higher risk portfolios through the up and downs, right? And so I would never recommend any investors, no matter how sophisticated they are, to just look at expected returns and pick their portfolio. Like I said, it's important, but it's only half the story. You also have to look at the risk side, and not only long-term risk, but also short-term risk, and make sure that you can endure that up and downs that portfolio brings to you to be able to enjoy the higher expected returns.
Essentially, there's no free lunch. If you want it, you must know the price that you're going to pay for
exactly. it. Exactly. And so to make sure that you're prepared to endure the up and downs and the risk involved in achieving potentially that higher return.
Right. Okay. Thank you so much, Dr. Peng, and thanks for your time today and all the other episodes that we have done so far.
No, thank you for having me here. I really enjoyed the conversation, and I hope everybody also enjoyed and more importantly, have a little bit better understanding of these investment topics.
Right. Yeah. So once again, thank you to all our listeners, and we really hope that you found this discussion and all our previous discussions are really useful. And as Dr. Peng mentioned, to give you more confidence to start investing if you haven't already, or to continue investing if you have already. So if you like this episode, please subscribe to our channel. So in our channel, we also upload our podcast where we will have episodes such as Chris reviewing articles that he writes for the Business Times, our Story Brand podcast episodes, and also CPF related contents. So as always, thank you for listening, and I'll see you in the next episode.
Thank you.
All analysis, views or opinions from interviews, recommendations and other information broadcasted, or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.